Hello, everyone. Today on the Final Bar, I'm talking with Dave Landry of DaveLandry.com. We'll see some of the charts he is using to make sense of these markets, continuing to be a choppy market environment with risk assets like equities moving higher in the afternoon, finishing toward the highs of the day with the S&P finishing just above 40.50. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the best practices of technical analysis, focusing on the charts, message of price, breadth, sentiment, trend, momentum, all those ways we can measure investor performance, investor decision-making, and quantify investor psychology using the charts. We're going to talk about a number of different charts, a series of them, by the way, things like financials, other individual names that have had been sort of in a pullback mode, starting to rotate higher. Using an indicator like MACD or PPO, we can sort of identify some of those charts that are rotating just at the beginning, potentially, of a recovery period. Might be one more additional sign of a further upside to be had here, but we'll look at those charts individually and as a whole as we talk about this market environment. Let's get right to our market recap. As I mentioned in the introduction, the S&P finishing in a position of strength, selling off in the morning after a gap higher, but the afternoon really strengthening with the S&P closing just above 40.50. That's up over 0.5% from yesterday. The Nasdaq 100 leading the way higher, up almost 1%. Mid caps up as well. Small caps actually finished just narrowly in the red, which immediately when I saw that playing out this afternoon, I thought of my conversation yesterday with Callie Cox of eToro. We had a really good conversation on a number of different topics, but particularly the lack of small cap leadership, right, has been a theme that we've come up with. I might touch on that a little bit today again as well. Volatility continuing to decline also, with the VIX moving lower by just a touch, just above 19 right now. And again, that's down from the mid upper 20s, which is where it was not too long ago. Interest rates overall continuing to push lower, although the short end of the curve actually pushed it a little bit higher. 10-year yields down about 15 basis points to 355. We'll go to the commodity markets. Overall, you're seeing strength in the commodities, generally speaking, with gold and silver both up. Silver, the best performer out of the 8 commodity ETFs that we're tracking here. The DBC up in the positive as well. Energy prices moving to the upside there. Finally, we have cryptocurrencies, mostly red, actually, with Bitcoin down about 1.4%, Ether down to 1780. But overall, when you look at the chart of Bitcoin, you're seeing that 30,000 level, which seemed like an unreachable level not too long ago. Actually, once again in the discussion, Bitcoin's just below 28,000 here as we go live just after 4 o'clock Eastern. Let's look at a chart of the S&P 500 and how things have played out, what today's move means relative to the rest. So yesterday, we talked about the S&P closing above its 50-day moving average. The last time that happened was actually back in early March. So we've spent most of the month of March below the 50-day as the S&P pushed back to test 3,800. It bounced off of that support level in early March, and now once again toward the highs of this month, and it looks for now like we're going to finish this first quarter up toward the upper end of the range that we've been in for the first 3 months of 2023. The S&P closing above 40.50 just barely today. That matches the close that we had in early March. We'll see if we can continue to power above there. The last time we pushed above 4,100 was in early February. I think of that as sort of an initial test of the November-December highs, which is where we peaked at 4,100 there. We retested it, closed above it for just a couple sessions, and then that was it. The market rally stalled out, and we sort of rotated lower, gave back all of those gains to retest the December lows. We've been range bound in this S&P between 3,800 on the lower end, sort of 4,100 to maybe 4,200 on the upper end. Does this market have enough upside catalyst or upside momentum to push above 4,100 and stay there? I think that's the open question for the market. It's what we were unable to do in early February. So I'd look to see if we were able to do here in late March. Also worth noting, the RSI is pushing higher, just below 60. Now, why this is important is because in a bear market phase, the momentum often stalls out with the RSI around 60. If you look back over time, when the market's been in a bullish phase, the RSI tends to be a little more elevated. So we don't get much below 40 on a pullback. We tend to get up to the overbought conditions in a rally. In a bear market phase, you see the opposite. You see the RSI often become oversold, and you stall out when you get to a momentum, an RSI level around 60. We're kind of right there. So we're testing resistance with improving momentum. Do we have enough to power through resistance and get enough upside momentum, suggesting that we are still in a bull market phase? I think that's the open question as we begin the month of April going into next week. Let's talk about some other markets here very quickly and talk about some individual areas of the market on the move, some of the sectors and themes. It's worth noting on a day like today, with overall a constructive move to the market, the S&P up about 0.6%, real estate, which is a fairly boring defensive sector, once again toward the top of the leaderboard, edging out technology in the leader spot, up 1.3%. Tech and consumer discretionary, too, the FANG sectors were after that, up 1.1 and 0.9%. Only one of the 11 S&P sectors was down on the day, the financial sector down 2.25%. Now, before you think about real estate and technology as kind of the same, the two sectors at the top, this is why charts, I think, are so helpful, because it helps you understand the relative movements. It's not just about today's trading, but it's how today's move fits into the bigger picture. Let's look at the chart of technology versus the chart of real estate. You can see how they're coming, even though they're both up a similar amount today, they're both coming from very different starting points. Technology, the XLK looks a lot like the Nasdaq, looks a lot certainly like the semiconductor space. If you look at the SMH or the SOX, you'll find a similar sort of pattern to what we see with the technology sector as a whole. Sort of this rally off of the October lows, the higher low in late December, early January. Once again, a nice higher low here in February and March. And now, once again, making a new swing high. So it's a reminder, whether or not you're optimistic about market conditions, with a sector like technology, it continues to make higher highs and continues to make higher lows. And as long as that pattern continues, the trend is bullish by definition, right? That's not a judgment call. That's just a clear definition based on the trends that we're seeing. So the XLK making another new swing high earlier today, notably testing the August peak, which is right around the same level, just above the current level, right about $150. That was the high close in August. We're right back there. So we've round tripped from the August peak to the October low, back to the peak that we're seeing here this week. Do we have enough momentum, again, to power through that level to the upside? And I think that's the question for technology. My analysis of the trend would say, for now, it certainly appears to be the case. Now, compare that chart we just looked at to the chart of real estate, the XLRE. You can see while they're both up about 1.3%, coming from a very different place, right? So real estate actually coming off of a position of weakness. Not too long ago, about a week ago, we're thinking about a retest of the October lows, which is arguably what this March move was doing, sort of breaking below support in December, sort of in the ballpark of the October low. And now we're just bouncing off of those very beaten down levels. Real estate strikes me as one of those areas of the market, like financials and others, that have been struggling recently, but are just starting to turn higher. One of the indicators I want to add to the mix to sort of help us make sense of this is an indicator called PPO. The PPO is similar to the MACD indicator, pretty widely followed. This is a classic trend following device, just helping you capture uptrends and downtrends. It's not necessarily a leading indicator. I don't think of it as that, as much as a confirmational indicator. Similar to moving averages, it's meant to lag behind the movement in price and confirm when a rotation has occurred. A buy signal is something we've just observed here in the last day on the real estate ETF. If you look at when, going back, the PPO level has been very low, meaning below zero, and you get a buy signal where the PPO line or the MACD line crosses up through the signal line. That's your buy signal. The last ones we got were here at the late December low. We got one at the October low. We also had other signals at the June and May lows of last year. We've just gotten another one of those signals today. Now, while that doesn't necessarily mean, real estate's going to new all-time highs or anything, it does tell you that thinking about the normal cycle of rotation from strength to weakness on the shorter time frame, we've come out of a period of weakness according to this indicator and now entering more of a rally phase. What's interesting is you're seeing the same thing on the financial sector today as well. The XLF, of course, has been beaten down. This is related to banks going under, some, minor significant market moving events we've experienced here in the last week and a half or so. And again, the fact that we're talking, that's the ripple effects for now have been limited, I think is pretty impressive. compared to the emotional reaction a lot of investors had to the reality that banks were not going to survive this sort of crisis. But if you look at what the XLF chart is telling you, we once again went back down to the June low, which is where we were in September and October, and it's right about where we've been here in mid-March after the sell-off over the last week and a half. Look at what's happened, though. We became oversold. We've shopped around a little bit, but the PPO indicator, once again, giving a bit of a buy signal. And again, there's no guarantee as to what the upside target would be. This is just telling you about the character of the trend and the fact that it's turning. But some of these areas of the market, like REITs and financials that have been underperforming, are now getting a buy signal from the PPO indicator. Tells me we're now entering potentially more of a rally phase for the broader market. Some of these lagging sectors are actually starting to show some renewed strength as well. For a while, it was sort of technology working and a lot of other things not. Now it's sort of like everything working, and it's just degrees of strength from the strongest to the weakest charts. Now, it's not just the XLF. If we look at Key, one of the regional banks, you'll find a similar sort of pattern. Now, I will tell you right off, I'm not a fan of a chart like Key, about, sort of buying the falling knife. You're assuming that the negativity has now been priced in, and now we are pricing in a recovery phase. I would much rather wait for the chart to tell me that there's more of an accumulation, but a buy signal from something like PPO could be that confirmation telling you that sell-off phase is now wrapped up, and now we're confirming more of a recovery period. I'd love to see some higher lows formed on this chart before I get really excited, but it's worth noting that you're seeing it. And it's not just in financials, right? We'll look at one other chart here just to wrap up our market recap. WPP, I was actually using our scanning engine to find other stocks that were giving a MACD or a PPO buy signal in the last day, and WPP, which is in the communication services group, actually showed up. Talk about a very different chart than real estate or financials, but one of those charts that really shows the change of character, I would say, from distribution in the first 3 quarters of last year to an accumulation phase in the last 6 months. Note the higher low in December. Note the higher low here in March. The rotation higher. We're testing the 50-day, but again, starting to get buy signals from these lagging indicators meant to confirm that a weaker chart has now become a lot less weak. Let's take a quick commercial break. We'll be back with today's guest, Dave Landry. We'll see you in a minute. Hey, everyone. Welcome back to The Final Bar. This is Dave Keller here at StockCharts.com. It is such a pleasure to put this show on for you every weekday after the close. Thanks again to my guest host, Julius DeKempener, stepping up in many ways over the last week to help us keep this show going for you. And we're excited to move on from here. A couple quick announcements before we bring on today's guest, Dave Landry. First off, we welcome your questions. We're going to do a mailbag segment on tomorrow's show, another mailbag segment on Monday's show. All of those questions will come from people like you, just trying to address the markets using technical analysis. You can email us your questions at thefinalbar@stockcharts.com. We're on Twitter at FinalBarSCTV, and we're on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We'd love to hear from you. We'll hope to answer your question live on the air on tomorrow's show. Upcoming guests next week, just so you know, on Tuesday, April 4th, one of my favorite guests, Chris Shavacco. I met Chris years ago when I was speaking at a CMT event in Atlanta, Georgia. Chris is the Chief Investment Officer of Shavacco Capital Management, a great thinker. He reminds me of people like Howard Marks types of people, which are more big picture macro thinkers that help you make sense of the markets and put the markets into proper historical context. You're not going to want to miss a really good conversation with Chris Shavacco. That's next Tuesday on this show at 4 o'clock Eastern. I'm going to welcome on our guest today, Dave Landry. Dave's the founder of DaveLandry.com, coming to us from New Orleans, Louisiana. Dave, great to see you. How are you?
Great to be back. I'm glad you're feeling better.
Thank you. I'm getting there, and I appreciate you coming on the show, Dave, as always. You always bring some charts that just kind of help us think through what the market is doing. It's been a choppy environment. I know there are a lot of question marks with instability and uncertainty.
Yes.
We're walking through a model that we've looked at before. It's a 10% system, looking at 10% off the highs. Can you walk us through this chart and what it's telling us about the conditions now?
Yeah, the design of the model is to get you out of trouble, the so-called diaper change moments from Ian McAfee, where you don't want to lose half of your money in the market. And that's the premise of the system, and more of a get you out of the way system than a buy system. But we are getting close to buy signal. If you look around point A, that was toward the end of the year, and we were making brand new highs, brand new closing highs. And the red line is 100% of that line, just to show you what close it's using. And then the green line is where you exit the market when it's below that, and the 50-week simple moving average. Very simple system to get you out the way. And you can see this time it worked out pretty good. Something like the pandemic, you're going to get some whipsaw, but you're able to sleep at night while the market loses about 30% or more. of its value. And what's interesting to me is we're actually, in spite of all the choppiness, which I'm going to touch upon as you have in a few seconds, we actually are on the cusp of a signal. In fact, if we close above that green line tomorrow, this will be a buy signal. Now, ideally, and this is something I didn't design into the system, but ideally you want to be buying on strength. So if we close below last week's low, I wouldn't get too excited about it. Maybe wait another week to see what happens. But technically, any close above that green line, which is also above the 50-week moving average, 2 weeks of Landry light, meaning the lows are greater than the moving average. Kind of hard to see down below. But the Landry light, which I'll flesh out in a minute in another chart, Landry light is just lows greater than the moving average for uptrends and highs less than the moving average for downtrends. So a little bit more of a stringent rule for the upsides to try to avoid getting whipsawed back in too quickly. But I found it interesting, even though the system was designed for the S&P 500, it does look like it has some merit in the Qs. A little bit more whipsaw in the Qs due to volatility. Maybe you want to use a little bit looser parameters on that 10% line, maybe 12% might be a better number to adjust for volatility. But interesting that we could have a sell signal in spite of the market in general not looking fantastic.
And I like, just to be clear, this is the TFM 10% system for trend following moron.
Trend following moron. That's right. The goal was to just come up with something really, really simple.
No, I love it.
It kind of shocked me that it worked.
No, and it's funny because I was taught all large losses begin as small losses. And what I love about this is if you limit your losses like 10% down, it's like move on, right? And find something else. And there's such a simplicity, but a power to that, because you eliminate the probability or eliminate the possibility of having an overwhelming loss. That's what Ian, our former mutual friend, would have certainly said, right?
Yeah, God rest his soul. And the idea, just going back to basic technical analysis, if a market's going to lose 50% of its value, it's going to lose 10% first, and 10% is a good round number for the S&P 500. So that's the whole premise of the system. Just get out the way.
Yeah, and interesting, the Landry light showing that space between the moving average, the 50-day moving average, and the recent price action. So see if we get that to close out the week. Your second chart is looking at the S&P again with your Landry light indicator. What is this telling us?
Yeah, you can see, if you go over to the left, you can see we had upside Landry light, meaning the lows are greater than the moving average. And the little indicator down below, or as I like to call it, an illustrator, counts the number of bars of Landry light, not the magnitude. And you can see when the moving average crosses, or sorry, when the price crosses moving average, the count goes back to zero. And then most of this year, in fact, going all the way back to 2022, so all of last year, we had mostly downside Landry light. And then in more recent times, we've had some upside and downside Landry light, or none whatsoever, meaning the price is crossing the moving average. And in this case, I'm using a 30-day exponential weekly moving average. And what's interesting is always look at the net price change. And we haven't gone anywhere in about a year. And that's part of my frustration as a trend follower. You can't catch a tan if there's no sun. You can't follow a trend if there is none. I might write that one down. Yeah. But what's interesting, just real quick, you were pointing out some of the things that we were talking about before the show, some of these areas that are doing really well. And it's kind of becoming a market quickly of believe in what you see and not in what you believe. And it's like, I'm feeling kind of bearish, but we're starting to get some signals and signs and areas improving. And I'm glad you pointed some of those out earlier, because it makes a lot of sense to follow those areas.
Yeah, it's been a chart like this, the weekly chart of the S&P, just showing, I mean, again, directionally, we've gone nowhere. What, for someone who's just getting started and hasn't experienced one of these kind of frustrating sideways markets, what would you tell people on how to navigate through this and find success at a time when it feels like just nothing's happening?
Yeah, you've got to be careful not to try to make something happen. And it goes against the neurology and our human psychology. The more successful you are, the harder it is to sit on your hands, and you're always trying to make something happen. I have a Facebook group, and I'm watching the guys in there that are really good traders, and it's like they're starting to show more and more mediocre setups. You can tell they're just getting tired of sitting on their hands. So learn how to sit on your hands, wait for the opportunities. Jimmy Rogers once said, wait till his money line in the corner, and all he does is walk over and pick it up. Very, very hard to do. I've been over trading way too much. And practice what practice. I'm not always practicing what I preach. So do what I say, not what I do. And it's hard because I'm here all day looking at all these screens,
That's right. So, that's right. But great advice not to force it, right? And to wait for a good opportunity that comes.
Absolutely.
Up. Well, speaking of an area of the market where we've seen strength, semiconductors has certainly been one of the stronger places. Charts like NVIDIA, we've highlighted before. What does the chart of the SMH using your Landry light indicator tell you about the
it's interesting that I was looking at XLK and it was a toss up between XLK and SMH for this chart. So I noticed, I'm glad you covered that earlier. I'm a big fan of having the semis confirm what's going on in the market or possibly helping us lead the market out. And I'm encouraged what I'm seeing in the SMH or other ETFs that track the semiconductors. But you can see we've got mostly green upside Landry light, and that's been happening for a long time. And in more recent times, we're beginning to pull away from that moving average, which is certainly a bullish thing. And then, of course, always look at the chart, regardless of what the indicator says, and notice that we're making multi-month highs in here. So pretty bullish right now in the semis. If they could follow through, they'd have to get a little bit higher than they are now to get that base behind them, and then maybe look to play this on pullbacks. And certainly on an individual issue basis, we should start seeing some setups here fairly soon.
Semiconductors have been strong. Another area of the market that's been strong that I know you focused on is cryptocurrencies.
Yeah,
we had a guest earlier this week, Adrian Zadunchik, who talked a lot about Bitcoin. When you're looking at the chart of Bitcoin, Ethereum, constructive setups here as well for you, or how would you translate or interpret what you're seeing here recently?
Well, today's action is a little concerning because we sort of had a little bit of a fake out. But if you take a bigger picture or 10,000 foot view, you can see that we've had some upside Landry light as of late, and we've had a pretty good trend. We did roll over for a little bit. That really didn't materialize into anything, fortunately. And then now it looks like the trend is still up. Although I wouldn't jump in midstream like this. I'd wait to see if it could break out and stick if you're not already long.
And when you're thinking about overall risk management and just going back to the chart of the S&P 500, some of the levels that we've talked about, is there, we've seen some constructive behavior. We've seen some improvement areas like semiconductors working. I'd love to just know, what would you see, Dave, that would be more of a bearish sign? What would you see that would be okay, this is no longer working, we need to start getting defensive? Is there a level or a signal or a breakdown in a group like semiconductors that would tell you something's different?
Well, just something as simple as you can look at the 30 EMA and the SMH. If we pull back below that and stay below that, the 200 and the 50 obviously are well watched. Not my favorite indicators, but I do pay attention to them because everybody pays attention to them, right? So if we get back below those levels in the S&P 500 and the SMH, I would start getting a little bit more concerned. I'm not too excited about the S&P just yet. As you can see, looking at a bigger picture weekly chart, we haven't really broken out of that, I want to curse, this stupid range we've been in, which has just been a killer for the trend follower. But, getting back to your question earlier, the net price change is probably your most powerful tool, especially for a beginner, because once you get a little smarter, you think you can outsmart the market. But look at this market just going absolutely sideways for about a year. So there's no trend to catch. So just sit tight. I would like to see us obviously get out of this range, and I feel a lot better if we break back below the range. As you know, that's going to become overhead support. That's places where people likely have bought, and they're going to be looking to get out of break even. So that's, answering your question about concern. That would concern me if we drop below the support that we've been seeing in here below those recent lows.
One more question. We have about a minute left, Dave, but I love with something like semiconductors that have really, started, they've been the strength, to be honest, for a while. And charts like NVIDIA, we've highlighted, looking at, I wanted to see what your Landry light was. I mean, consistently strong, because it's been in such a good uptrend. Is something like this a little too extended? And if you're looking at a chart like this for the first time, what's an entry point on average? And again, generally look like for you?
Well, I normally play pullback. So if you're new to trading, maybe look for something like Landry light and a pullback to the EMA. If you look at the last pullback way back in time, notice it broke through the EMA, so you wouldn't have gotten a trigger on that. So that would have been no signal there. But if you look a little further up, although it gapped up, you had a really nice pullback to the moving average or thereabouts. But unfortunately, it gapped higher the next day. So that's the kind of thing I would look for. As far as extended setups, right now, if something is going straight up for a long time, I would be concerned about it, more concerned than normal, because that market could become a source of funds. If we either roll back over, or if we get in a rally, managers will sell that stock and then buy something at a cheaper level. So it's a little counterintuitive, a little bit longer conversation. If you have me back, I'll be happy to flesh it out a little further. But source of funds can be a concern. It's a little counterintuitive, though.
I love that subject. We're going to find some time to talk through that a little bit further, Dave. But for now, I'll have to say goodbye. Really appreciate you coming on. Great charts and great perspective as always. Be well there, and best to Marcy and everyone there, all right?
You too. Feel better. Thank you.
That's Dave Landry. Dave's the founder of DaveLandry.com. And again, I love the simplicity. I love two things about Dave, among many. Number one, the simplicity to his approach, right? It's easy to see the visual representation, what he doesn't call indicators, but illustrators, showing you the dynamics of the market and how important that is to just recognize the simple messages that the market's telling you. And the second thing is to not take yourself too seriously, which I love about Dave. First time I met Dave, we were sitting next to each other at a conference, probably one of my favorite conferences I ever attended, just because of the side conversations we were having along the way. Great take there from Dave Landry of DaveLandry.com. Folks, we have to wrap up our show with the 3 and 3. Let's hit on 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. When we talk about market breadth, talk about the conditions. Again, it's easy to focus on some of the leading groups like semiconductors, and I agree with Dave's take, strong group, strong charts, and a lot of them just really continuing to emerge in positions of strength, but they've been some of the best performers. What I'm interested in are some of the measures of breadth that show you, is it other groups, not just semiconductors, but others that are starting to participate. One of the more bullish things that I've seen change over the last week since I left on vacation, now coming back and reviewing all the charts, are the improvement in breadth indicators. Things like the McClellan oscillator, which went from below 0 when I left to above 0. The bullish percent index on the S&P 500, which had been below 30%, now back above, which is more similar to rally phases. Now we see that over 50% of the S&P 500 members are above their 200-day moving average. So just like the S&P went below its 200-day earlier in March, it's rotated back above there. And you're seeing that this breadth indicator is getting back above 50% as well. Well, that's not my most perfect trading system in history. It's not how I would time a portfolio allocation. I have learned that conditions are better when this indicator is above 50%, because that tells you most stocks are in a bull phase because they're above their 200-day. That is the situation we find ourselves back in. So I'm finding a lot to like about improving breadth conditions off of the lows earlier in the month of March. Chart number 2 is looking at high yield spreads. One of the indicators that I like to look at outside of the equity space is spreads within the high yield market. This is an area of the fixed income markets called high yield bonds or junk bonds, basically bonds of riskier companies, and what sort of spread that bond investors are requiring above a risk-free rate, essentially. This is plotted inversely. I like to plot the high yield spreads inversely, the VIX inversely, because that lines up with the S&P, which is plotted in its normal way. You can see over the last week, high yield spreads have stopped widening, starting to narrow a little bit. Volatility has stopped expanding and has actually come off a bit, with the VIX back below 20. And as a result, the S&P is actually rallying. If this rally phase were to continue, if the S&P leaves 4,000 in the rearview mirror and continues the upside, I would argue that's most likely going to happen on lower volatility, with the VIX remaining below 20 and with high yield spreads continuing to come in. This might be an important chart to watch to see if you get that confirmation from these two other areas of the market. Finally, a chart like Lululemon, this is as I was looking at charts that have been gapping, charts that have been on the move. Lululemon was on the top of the list yesterday with a big gap to the upside, gapping above 360 today. Actually closing lower. So yesterday you had the gap up on the open. We closed more at the lows of the day. Today, same sort of pattern. So this is not a super encouraging short-term sign for me. When you open higher and close lower, that tells you during the day that there's distribution. What's also happening is Lulu is doing this sort of gap and distribution move right at previous highs. We're right at resistance from the September peak, the November peak, and also not too far below the April peak. So we're at the upper end of the range, we're overbought, and we're showing the short-term distribution. Charts like this, I think, look a lot better if you actually don't just get to resistance, but through resistance. Can you see that additional buyers are willing to pay more than $360 a share? First, now, I'm not seeing that yet. Folks, that's a wrap for this show. Special thank you to Dave Landry of DaveLandry.com, joining us from Louisiana, sharing some great investment wisdom with him. All of our previous interviews can be found at StockChartsTV.com. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night. Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.